Hello, my name is Elina Linderman, and I have been invited by the Masterpiece Properties to talk to you about investing in foreign real estate. Why? Because I specialize in taxation related to foreign investments. And why me? Well, because your accountant doesn't know. How come your accountant doesn't know? Because it's a very narrow expertise. So it doesn't mean that your accountant is bad. It just simply means that your accountant doesn't specialize in those things. So here we are. I'm here to teach you about investing in foreign properties. Let's begin. Actually, let's continue. We've discussed in our previous videos how to actually invest, how to start that initial investment. We also discussed what happens during the investment process. And our final video, we will discuss what happens when you're ready to sell. First of all, we need to understand that when you sell, there's a specific formula for calculations of your profit. And believe me, it's not what you think it is. We look, of course, at your sale price. We look at your purchase price, and that's simple and elementary, and everybody understands that. However, there are other considerations. If for some reason, most likely you will not, but if for some reason you did some kind of capital remodeling, what is that? This is when you're making major changes to your investment properties. You're changing floors, you're changing windows, something major. So the cost of those major repairs, we can actually add to the cost of your property. So if you purchased your property, let's say for $100,000, you've spent $50,000 remodeling it. Now it's $150,000 that your property is valued. So when you sell it for $200,000, you only made $50,000. But wait, there's more. Let's say you paid commissions to your real estate agents. Those commissions are deductible. So now we're going to deduct it from your profit. But wait, there's more. Remember that depreciation discussion we just had? We have to take into consideration depreciation issues. So we discussed in a prior video that depreciation is what we in accounting universe believe is a loss of value. And we calculated, no matter what, it's not an option, it's a law. We have to calculate the loss in value. So let's assume that you are depreciating $5,000 every year. You've held the property for 10 years. So you now have extra $50,000. What do you do with that? That extra $50,000 actually increases the amount that you've earned. We have to add it into the formula. And most people forget about it. Most people think, I bought a property, and I'm simplifying my example, for $200,000. I sold it for $200,000. I will pay no tax. But no, that is not the case. If you bought a property for $200,000, you've sold it for $200,000, but you have, over the life of the property, used up depreciation in amount of $50,000, guess what? You now have a profit of $50,000 on which you have to pay taxes. How much? Well, we discussed in a previous video that it's very hard for me to tell you the actual number because we do not have a fixed tax rate. Well, you see, there's different tax rates that we apply to different types of income. If you hold this property in your possession for more than a year, then we're talking about long-term capital gains. Tax brackets are different when we calculate taxes on long-term capital gains. There are different tax brackets that could be 0, 15% or 20%. 20% is maximum number. Believe it or not, as strange as it sounds, because we're so used to that Uncle Sam loves to come to us for taxes. If your income is not very high, and I'm just using approximate values because they change from year to year. So for a married couple, it's somewhere around $80,000. So if your income is below $80,000 annually, your tax bracket on capital gains is zero. Believe it or not, zero tax brackets exist. So you will be paying taxes on the reduced tax rate, but on which specific tax bracket it's gonna fall, I really do not know. There are other taxes if your income is on a higher level. There is what we call an additional Obama tax. The tax was implemented whenever Obamacare came to be, and somehow our government needed to pay for it. So if you are a high earner, prepare to pay an additional 3.8% tax. And that's probably it on the federal level. Yes, you could have taxes on the state level or on the city level. Again, depending on where you live. And again, is your state eligible to be able to tax you on profits that you earned outside of that state? Well, the rules of every state will be different, so we have to look at the rule in your specific state where you specifically reside. Like-kind exchange, do you know what it is? Allow me to explain just in case. This is when we take one property and exchange it for another. And in doing so, we do not have to pay taxes in between. It's a very good way to avoid paying taxes, but please be aware whenever we are talking about investing overseas. A like-kind exchange is just not possible. However, you are entitled to use self-directed IRA if you wish. Self-directed IRA is a type of retirement type of investment. You basically invest, but not in your regular type of investments. You invest into what you like. That's why it's called self-directed IRA, including into a property. And then things become wonderful, marvelous. Imagine this. You invest through your self-directed IRA. All the money goes back in. Whatever is earned, it goes back into your retirement plan, but you don't pay any taxes on that money. And even when you sell, you still don't pay taxes on that money. The only time you really start paying taxes is when you take out the money from your retirement plan. But the logic is this: when you put in the money in, you're at your highest earning potential, you're earning the highest possible amount, therefore you are being taxed at the highest possible rate. Whenever you're going to retire, your kids have grown, your house has been paid off, you don't need nearly as much money to live off. Therefore, you will be taking significantly smaller amounts in withdrawals, and you're saving on the tax rate. For that reason, I am recommending you, if it's possible, to consider using your retirement plans as a type of investment into real estate. It's a very, very cool feature, and if you guys are interested, we can definitely record another video. Please let us know if that's something that you would like to learn more about. There are many other possible strategies that we can utilize when we're talking about investment. But a lot of those strategies, like I'm telling you right now, the theory and the principles, but they need to be developed on a custom basis. But because I really don't know, as we discussed already many times, in what state do you live? What your state's rules might be? Do you have kids? What's your other income? I can really develop the best possible strategy for you depending on all of those unique circumstances that's specifically applicable to you. And of course, when we're talking about foreign investments, don't forget about foreign accounts. We discussed foreign accounts in the previous two videos, so you will be reporting foreign accounts as long as you have that investment through the life of that investment. Of course, if you're choosing to do so, if you're using cryptocurrency, as we discussed, you will be doing completely different thing. And yes, there will be different reporting. Can you pay By wire, can you pay using crypto if you're using your retirement accounts for your investment overseas? Yes, of course. You can do all of the same things inside of your retirement account as you can do just investing as a physical individual. So I highly recommend, if it's at all possible, and if you do have enough funds in your retirement account, to look into that option. I hope that those videos were educational. You found a lot of answers. But if not, we will be happy to answer your questions. You will have all of my information. Feel free to schedule a consultation with me.